Good evening, everybody. So my name is Peter Ashton. I'm from Recognia, where I am the Vice President of Retail and Self-Directed Investing. And welcome to this webinar on Introduction to Technical Analysis. So in this webinar, we're going to start with a little bit of an introduction to technical analysis for those of you who have never traded this way before. We'll talk a little bit about some of the history of technical analysis and about market cycles and what those mean. We'll talk a little bit about trend lines and how you can actually draw those on a chart, and about the concepts of support and resistance. We'll then move into talking a little bit about some of the different types of technical events that are recognized in the Recognia software. Typically, we'll talk about the short-term patterns, indicators and oscillators, and also what are called the classic patterns. And we're going to wrap up with a live demo using the KBC Bolero site, and I'm going to actually show you where to find the Recognia tools, how you can actually use them as part of your day-to-day trading and investing. Before I begin, I just wanted to say quickly that we're going to talk about some specific stocks and different investments as part of this webinar. All of this is provided for illustrative purposes only. None of the information in this presentation is intended to constitute a recommendation by Recognia to buy, sell, or hold any stock, option, or securities. So let's begin with talking a little bit about what is technical analysis. So at its core, technical analysis is really all about looking for patterns in the relationships of price and volume that identify the attitudes of buyers and sellers in the marketplace. So if we think about every trade that takes place on an exchange, that trade represents an agreement between a buyer and a seller for what is the fair price of that security at that moment in time. So by following these shifting balances of price, it tells us something about the supply and demand for that particular stock in the marketplace. And that particular price has taken into account all that's publicly known about that stock in the market today. So it takes into account the fundamentals, takes into account the news, takes into account the general market sentiment about that particular stock or that segment of the market. And by following these shifts in supply and demand, it can help us to make better investment and trading decisions. Now, many people are surprised to learn that technical analysis is not something new. In fact, technical analysis dates back to the rice markets of Japan in the 1600s, so it's more than 400 years old. But modern technical analysis, like we practice today, really dates back to Charles Dow. And this is the same Dow we know from the Dow Jones Industrial Average, the same Dow from who was the first editor of the Wall Street Journal. But Charles Dow observed the stock markets back in the late 1800s, and Dow believed that there were a number of cycles in the market, and prices tended to move according to these cycles. So Dow identified what he called the primary trend, so the blue line on this particular chart. And Dow felt that the primary trend lasted anywhere from 9 months to 2 years. And superimposed on top of that primary trend, we have an intermediate term trend drawn in green, and that lasts anywhere from 6 weeks to 9 months. And further superimposed, we have a short-term trend in red, which lasts anywhere from 2 to 6 weeks. So what's interesting is, notice in some places, all these three trends are moving in the same direction. So for example, over here on the left-hand side of the price chart, we have places where all three trends are moving up. However, on the right-hand side, we can find places where the short-term and intermediate-term trends are up, but the primary trend is down. So understanding where you are in these relative trends is very, very important to trading successfully. And in many cases, trading losses tend to result when we're actually trading counter to the prevailing trend. Let's talk a little bit more about trends, and specifically let's talk about trend lines and how we would draw a trend line. So here we have an example of a stock that's in an uptrend, and we're going to actually draw an uptrend line. And the way we draw an uptrend line is by joining together the lows making up that particular trend. And for this to be a valid trend line, it needs to touch the price chart in at least 2 places. So we're going to see successively increasing lows in an uptrend. We're going to connect together at least 2 of those lows to form an uptrend line. On the other hand, we also have a downtrend. In this case, we're going to draw our trend line connecting together the highs in a downtrend. And here we've actually drawn together 5 different highs to create that downtrend line, which is good. So the more places we can touch the trend line, the better, the more significant the trend line is going to be. Now, a mistake that sometimes early technical traders tend to use is they draw their trend lines incorrectly. So for example, this is not a valid trend line because it only touches the price chart in one place. We have to connect together 2 of the highs before this becomes a valid downtrend line. Similarly, this would be an equally invalid downtrend line because it doesn't touch the highs in any place. So there are certain ways you have to draw these trend lines, specifically touching the highs or the lows in at least 2 places. Now, we often hear what are called trend channels, and these are just basically trends which actually show upper level resistance and lower level support as part of a price trend. So for example, here I'll draw an uptrend line connecting together, let's see, 1, 2, 3, 4, 5 different lows on the price chart. And I can also connect together the highs as well. And this forms what's called a channel. And the channel represents an area in which there's support below and resistance above, and the price will tend to oscillate in between those particular lines. When we break out above or below the trend channel, that can often be the start of a new bullish or bearish trend. And since we're talking a little bit about support and resistance levels, let's talk a little bit about what they are specifically. So a support zone represents a concentration of demand. A support zone is where new buyers will come into the market at a certain price, creating a level of support. Similarly, a resistance zone represents a concentration of supply. So a resistance zone or a resistance line is where we would actually have additional sellers coming into the marketplace, and that would tend to resist the upward inclination of a stock price. So we'll look at a couple of examples here. So here is a price chart, and you can see the price is declining, but we have a level of resistance at A, or sorry, level of support at A. So the price is actually supported at level A and actually bounces off that level a couple of times before actually breaking through. Again, it's supported at level B, so it bounces off once before breaking through. Then it finds a final level of support at C. So we actually have 1, 2, 3, 4 times it actually bounces off that support level at C before resuming its uptrend. Now what's interesting is that what are support levels on the way down become resistance levels on the way up. So as we're moving up from C, the level A now becomes resistance to the price of the stock. We eventually break through the resistance at level A, and again, let A now becomes support for the stock price as we fall down and bounce off it again. So understanding where support and resistance on a chart is actually very interesting. And where are support and resistance levels likely to develop? Well, they tend to develop at previous highs and lows, as I've just shown you on the preceding chart. Sometimes they develop at round numbers. So numbers like 10 and 50 and 100 are very significant on price charts. That's because people's minds work in a certain way. They'll say, I want to sell the stock when it hits 100. So 100 becomes a level of resistance. Or I'm going to buy if this stock drops down to 10. So 10 will become a level of support because lots of buyers will come into the market at 10. Similarly, there are emotional levels on the chart such as gaps. So sometimes a stock will close at one level and open the next day much, much higher than it closed the previous day. That is called a gap. And those are emotional disconnects in the price history of a stock. Those can also become support and resistance levels going forward. I'm going to show you as we actually do our demonstration of Recognia how you can use Recognia's analytics to actually find support and resistance levels automatically on any price chart. If anybody comes away from this presentation with a desire to learn a little bit more about technical analysis, then I very highly recommend this book called Technical Analysis of Stock Trends. This is by Robert Edwards and John McGee. This book actually came out in the 1950s. It's currently in its 9th or maybe even its 10th edition now, and probably as close as there is to a Bible of technical analysis out there. One of the quotes I wanted to use from this book is, why are technicians so obsessed with studying the price? Well, we study the price because the market price reflects the hopes and fears and guesses and moods, rational and irrational, of hundreds of potential buyers and sellers. Price is the only figure that counts. So this reflects the belief of Edwards and McGee that by studying the price, we're also studying all the things that go into driving that price, which includes the fundamentals, includes the news, includes the general market sentiment, and so on. So let's spend a minute now talking about some different kinds of technical events. So technical events are a term that Recognia uses to refer to things that are of interest to a technical trader. I'll give you some examples in just a minute, but we've grouped these into 3 different classes. We have first what are called the short-term patterns, and as the name suggests, these are events that form over a very short period of time, sometimes in a single day or over a period of a few days, and they tend to have influence for a fairly short period of time. But these are based on the shape and relationship of candlesticks or price bars. We'll also talk about the indicators and oscillators, probably the best known type of technical events, and also about the classic patterns, which I think are probably the most actionable type of technical event. Let's begin though with the short-term patterns. So here I've drawn an example of a short-term pattern. This is something called a hammer. And why is it called a hammer? Well, that candlestick you see there kind of looks like a hammer. It has a a hammerhead on top, and it has a long handle coming down. And this is what is known as a bullish reversal pattern. It indicates the previous bearish trend that you've seen going on for many days is likely to reverse. And that is in fact exactly what happens in this particular case. Well, why is that the case? Well, let's think about what is the sentiment of traders on the day that this particular pattern occurs. So the price actually opens right near the highs of the day. It immediately trades much, much lower during the course of the day, but then something happens and it reverses and closes back near the highs of the day. Well, why is that the case? Well, something's happened to reverse the sentiment of traders. So this is often seen as a sign of sentiment reversal, which is why we call this a bullish reversal pattern. The price very often moves higher after the occurrence of a hammer. Now, of course, the challenge of trading a pattern like this is you don't get the benefit of seeing what happens next. So how would you trade a pattern like a hammer? So I have two suggestions for you. One, if you are conservative, then I'd suggest perhaps what you might want to do is watch for the occurrence of a pattern like a hammer. And then for the next couple of days, you're going to watch the price action and see what happens. If that reversal takes place and the stock starts to move higher, then you probably want to say, okay, my hammer is confirmed. Now I'm going to take my position in this particular security. If you're a bit more aggressive, what you may want to do is actually buy the stock immediately upon identification of a hammer. But in that case, you're going to want to make sure you have a stop loss order in place such that you protect yourself in the event that the price happens to go in the opposite direction than you expect. Here I have two more examples of short-term patterns. This is called a shooting star. Shooting star is the bearish counterpart of the hammer. So hammer is a bullish reversal pattern. Shooting star is a bearish reversal pattern. So here we have two different examples of a shooting star. These are both very valid examples. Notice one has a white real body, one has a black real body. It doesn't matter. Those are both valid examples of a shooting star. However, I like the shooting star on the right-hand side better, and I'll tell you why. I like it better because, number one, the tail is much, much longer. So that tells me that the reversal of sentiment that took place is much, much larger than the shooting star on the left-hand side. I also like it better because it comes at the end of a long uptrend. So oftentimes these reversal patterns tend to work better when there's a strong trend to be reversed. Excuse me. Let's move on and talk a little bit about the indicators and oscillators. And again, indicators and oscillators are probably the best known type of technical events, and they're typically based on moving averages and various mathematical functions. So there are really three types of indicators and oscillators, one called trend following. These are basically things like moving averages that help to smooth out bumps in the price so that the trends can be much more easily seen. We have some types of indicators and oscillators that are known as momentum oscillators. These are basically measuring the speed or the direction of price changes and telling you how strong that trend is. And we have something called stochastics, which measure the position of the closing price relative to recent highs and lows. Let's look at a very simple example of an indicator. And this is I'm going to use moving average as my example. So many of you have probably used simple moving averages over the time you've been trading, and they're very, very useful to see trends that are developing. And a simple moving average is just defined as taking the closing price of the stock over the last n days and then dividing by n to give you this simple moving average. These tend to work best in trending markets as opposed to markets that are moving sideways. And people often ask why we use certain time periods of moving averages, why we use the 21-day or the 50-day or the 200-day moving average. Well, there's no real reason. These are just historical numbers. So for example, in the silver market, the 200-day moving average was widely used because Kodak used to keep a 200-day supply on hand, and they were the largest buyer of silver in the world. We used to use a 4-month moving average for soybeans because that's the shelf life of margarine. So in many cases, these numbers are just historical, but they can still be very, very useful to traders. Here's an example of how one might use a simple moving average. And I've actually drawn two different simple moving averages on this price chart. In blue, we have the 50-day simple moving average, and in red, we have the 200-day simple moving average. And notice how we can use these. So first of all, notice how the 200-day simple moving average forms a very nice dynamic level of resistance to the price of the stock. Look how many places we approached or touched that line without actually breaking through. So if we were to actually extend this price chart beyond the right-hand side of what is shown here, and if the price was to come back close to that 200-day simple moving average again, we might expect it to bounce off rather than to actually break through. On the other hand, if we were to break through the 200-day simple moving average, that would be a very bullish sign because a previous level of resistance has now been breached. That would be the sign of a new bullish trend underway. Now we can use the 50-day simple moving average in a different way. So we could actually draw an arrow where the price crosses the 50-day simple moving average in the upward direction. Let's draw a red arrow where it crosses in the down direction. We could have actually used this as a very simple trading system. So we could actually buy the stock where we have the green arrows. So we're going to profit from these increases we see in the price. And we can sell the stock, or better yet, sell short the stock where we cross in the downward direction. So we'd profit from this decline, benefit from this small uptrend here, profit from this decline, and so on. So that would have made a very nice trading system, and you actually probably would have made money just by following that very, very simple set of rules. Now let's spend a little bit of time on the classic patterns. And again, I think these are perhaps the most interesting and the most actionable types of technical events. We'll spend a little bit more time on these for that reason. But classic patterns typically form a distinctive shape on the chart. And here's one you'll hear about frequently called the head and shoulders bottom. So you can see we have a declining market, or a declining market for the stock. Stock price is declining day over day, and here I've drawn a channel. And you'll see we have a head and shoulders forming, indicated here in red. And it's called a head and shoulders because it kind of looks like an upside down person. This is the left shoulder here, this is the head, and this is the right shoulder. So notice we declined and rallied, declined and rallied, declined and rallied. On that third rally, we broke through that horizontal level of resistance I have drawn here. That is called the neckline. And where we broke that neckline, it indicates the start of a new bullish trend. Very important when dealing with classic patterns, you have to confirm the pattern. So until this particular pattern had broken through that neckline, it was not a valid head and shoulders bottom. It means nothing in the context of technical analysis until it's confirmed. Now, the reason why I think the classic patterns are perhaps among the most interesting type of technical events is that they can tell us something about what may happen next. So the way that technicians do that is they can derive an expected move or a target price. The way that's done is by measuring the height of the pattern from the neckline to the lowest point of the head in this particular case, and adding that amount to the confirmation price. That tells us the expected move, or where the price is expected to go. And notice in this particular case, the price actually did go to pretty much exactly where it was indicated to go by the pattern itself. Now, technicians will also drive what is called a trading horizon. They do that by measuring how long the pattern is, the pattern length, where the price crosses the neckline in the downward direction, to where the price crosses the neckline in the upward direction. That is the pattern duration. We add that amount to the confirmation date, and that tells us the trading horizon. In other words, how long do we think it will take to reach the target price? So bear in mind, these are just rules of thumb. They're not hard and fast rules, but they are a useful indication for traders to say, here's what we think is going to happen, and here's how long we think it will take. Now, there are many different kinds of classic patterns, and because they're so useful, I wanted to outline just a few of them. One which is quite rare, but very, very useful, is known as the triple bottom. Triple bottom is the bullish pattern, and its bearish counterpart would be the triple top. So here's the triple bottom drawn here. You'll see we have a decline and a rally, decline and a rally, decline and a rally. That's the three bottoms. And we have a neckline drawn across as a red line. When we break that neckline, that signals the start of a new bullish trend. And in these charts, I'm using this green rectangle to show you the target price region. So the target price suggested by the pattern is this dark green region on the chart. And then the target price horizon, how long we think it will take to reach the target price, that is indicated by the width of this green rectangle. Now, a very similar pattern to the triple bottom is the double bottom. And of course, its bearish counterpart is the double top. So here we have two rallies and declines breaking through on the second attempt. And somebody asked me in one of my webinars recently whether it was true that all triple bottoms are also double bottoms. I had to think about it for a second, but in fact that is not true. Triple bottoms and double bottoms are two completely separate things. Once a pattern has broken the neckline, as it has done in this double bottom, it can never be a triple bottom. So it's not true that triple bottoms are a superset of double bottoms. Triangles are one of the most common types of classic patterns, and the reason they're so common is that there's 6 different types of patterns. There are what are called continuation triangles and reversal triangles, and there are also what are called symmetrical triangles and ascending or descending continuation triangles. But effectively, the phenomena of a triangle is that we have a level of support and resistance which is converging. So this upper level of the triangle here, that is our resistance level, and it is declining, and we have a support level which is actually increasing slightly. So what's actually happening is the price is oscillating in between those support and resistance levels. Eventually it has to break out either above or below, indicating the start of a new bullish or bearish trend. In this case, we've broken out above, therefore indicating a new bullish trend is underway, and here's the target price region suggested by this particular pattern. Upside and downside breakouts are also very useful and are fairly common. So again, it looks something like a double bottom, except that instead of coming in from the top, we've come in from the bottom. We have a level of resistance above and support below, and we oscillate in between those support and resistance levels. In this case, we've broken out above that upper level of resistance, thereby signaling the start of a new bullish trend, and we actually hit the target price very, very soon after confirming this particular pattern. Megaphones are also interesting, and megaphones are actually fairly rare, and I'll tell you why. The megaphone is the opposite of a triangle. Whereas in a triangle we had converging levels of support and resistance, in a megaphone those levels are diverging. They're getting further and further apart. The megaphone is a sign of a market that's out of control. The consensus between the buyers and sellers of a stock in the market is getting further and further apart. Eventually, either the bulls or the bears will have to get control of this market. The price will either break out below the bottom or above the top, signaling the start of a new trend. And then diamonds are fairly common types of technical events. And think about a diamond really as kind of a combination of a megaphone and a triangle put together. So we start with support and resistance getting further and further apart. So the opinions of buyers and sellers are diverging. Eventually something happens to cause their opinions to start to come back together. That converges. The price starts moving in a narrower and narrower band and will eventually break out above or below the triangle, sorry, the diamond, to signal the start of a new trend. And last, we'll mention the rounded top or rounded bottom. This is a little bit of a special case of a classic pattern. So whereas in all the rest of the patterns I've shown you, we've had very sudden changes in opinion in the marketplace, the rounded top or rounded bottom is a case where the consensus of buyers and sellers changes very slowly over a period of time. So here in this price chart, you can see that we have a very slow and gradual change from bearish to bullish, and then finally breaking out above a moving average crossover, and that signals the confirmation of this particular pattern. So rounded bottoms and tops are very rare, but a very useful signal in trading in the marketplace. So we've talked about a few different kinds of short-term patterns. We talked about hammers and shooting stars. We talked about price crossing the moving average. We talked about head and shoulders and a bunch of other kinds of classic patterns. And already many of you are probably thinking, wow, this seems really complicated, and how am I supposed to remember all of this? And it seems like a lot to learn. Well, don't worry, because Recognia has built software that automatically recognizes all of these different kinds of technical events. And we do this not just against a few different stocks, but against effectively every stock in the world every day. So we will automatically find all these different kinds of technical events for you. I'd like to say that we do the heavy lifting so you don't have to. Now, one question many of you may have is, well, this is all great, but how well do these patterns actually work? You know, what's the effectiveness of these patterns? What I'd like to do is just outline quickly for you the results of a study done by a famous technical analyst named Martin Pring. This is actually written up in Martin Pring's book called Martin Pring on Price Patterns. It's chapter 18 in that book, if anybody wants to look for it. The reason I bring this up is because it actually used data from Recognia's technical event database as part of the study. So before we begin, I want to just mention a couple little pieces of terminology. The first one is what's called the pattern length, and we already talked about this a little bit, but pattern length is measured from where we cross the neckline in the downward direction to where we cross in the upward direction. And if that actually takes 50 days, for example, to form that head and shoulders bottom, then the pattern length, or L, we will say is 50 days. Talking about the trading horizon, if it takes 50 days for the pattern to form, we expect to hit the target price in another 50 days. But if we want to wait longer, say 100 days, that's called 2 times the pattern length. And there's an even better probability of hitting the target price if we wait a little bit longer. We also talked about how to derive a target price based on a pattern, and that's done by measuring the height of the pattern. So let's call that pattern height h. And if we hit 1h, that would be 100% of the target price objective. But if the price of the stock went even higher, for example, if it went to 200% of the objective, or 2h, that would be a 200% achievement of the objective. So let's look at the results that Martin Pring got in his study. So he looked at a whole bunch of different patterns, more than 5,000 patterns out of Recognia's database. He looked at secular bull markets and secular bear markets. And he also looked at the success of bullish patterns in bullish markets, as well as bullish patterns in bearish markets, and vice versa. So let's begin by looking at how well bullish patterns in bull markets work. So what this tells us is this is the percentage of expected price met. So this says if we wait for 1L, so 1 pattern length is the amount of time we're going to wait, that 30% of patterns have hit 100% of their target price within 1L. 10% of those patterns have actually done much better, and they have hit 200% of the target price. So that's not bad. What if we're a little more patient? What if we can wait longer than 1L? What if we wait 2L or 3L? Or let's make it 5L. Well, in 5L, things get a lot more attractive. So within 5L, or 5 pattern lengths, 70% of the patterns had hit their target price, and 25% of the patterns were big winners, hitting 400% of the target price or more. So that's actually very interesting. Now, I won't actually bring up the data for, I will bring up the case of bullish patterns in bear markets. And here's an example. This is a head and shoulders bottom in a primary bear market. But if we look at bear markets, this is the success rate of bullish patterns in bear markets. What we find is that in 5L, 55% of patterns had hit their target price in 5L, 30% had hit double the target price, and 15% had hit 4 times the target price. So even in bearish markets, bullish patterns are fairly effective. So I think what this shows you is there's certainly lots of benefit of actually using these patterns, especially if you're willing to wait and be patient and wait several different pattern lengths. I don't have time to present to you the data for the bearish patterns, but if you want to look in Martin Pring's book, all that data is there. And in fact, the results for bearish patterns are very, very similar to what I've shown you here for the bullish patterns. So that's a very quick introduction to technical analysis. I'd like to spend just a few minutes now on a demonstration on the KVC Bolero site. So I'm going to switch into my browser. And I've already got the Bolero site loaded up, and hopefully you all see my screen. And what I'm going to do is begin by talking about a couple of different use cases for the Recognia software. I'd like to talk about number 1, how we can get some new trade ideas based on the principles of technical analysis. And we'll also review how we can stay on top of our positions and validate the technical perspective of any stock using this tool. So to get some new trade ideas, what I'm going to do is I'm going to come down here to the Ideas Center. And we'll click the Ideas Center. And I have several different ways of getting ideas here. I have some hand-picked stock selections from Bolero's stock picker. I have some Recognia fundamentally based stock ideas, and I have some that are based on technical ideas. And today, based on the theme of our webinar, I'm going to pick the technical ideas. And what I'm going to bring up here is something we call the featured ideas. So these are some ideas provided by Recognia based on the principles of technical analysis. So here you see we have a little ideas center, and across the top this is called the ribbon. This provides us with trade ideas. So as you may guess, the green ideas are bullish and the red ideas are bearish. We have 10 new ideas every day. So for example, today we've highlighted the very first one is Anheuser-Busch InBev, trading on London Stock Exchange. And this particular stock was chosen because it's had a pattern called a continuation diamond. Remember we talked about diamonds? So the stock is currently trading at 109.80. That's that purple line you see drawn across here, 109.80. We can derive a target price from this particular pattern. Well, our target price is shown here. It's 141 to 148. So if the price is to move from where we are today to the target price, that represents an upside of 33% for us. So you can see how these are all very immediately actionable. If I just scroll through a few more here, here's a, looks like a telecom, Pebblebrook Hotel Trust, and so on. So lots of different ways of actually getting some ideas here. If I want to investigate any of these in more detail, by the way, I can click on this charting icon, and this will give me a larger interactive chart to investigate. If I wanted to evaluate a longer price history, for example, I could just slide that slider out and I could look at a longer history of this particular stock. If I wanted to know more about this company's business, what they do, just click on the information icon, and this actually takes me right to a page that tells me more about the company, as well as some of its most recent fundamental data. Now notice I can actually buy and sell right from this page. If I want to buy the stock based on what I've seen, I can say buy. That'll take me to the equity order entry page on Bowlero's site. Maybe more likely, I want to just watch this for a little while. I want to put it on my watch list. So what I can do is click on watch, and this now changes to say watching. So this is on my watch list. So this little star here tells me how many stocks are on my watch list. There's currently 2. And I can toggle between today's featured ideas and the stocks that I'm watching, just like that. So here's the 2 that are on my watch list today. Now, a question some of you may be having right now is, well, this seems interesting, but how did you pick these 10 ideas for me? How do you know what I'm looking for, and why these 10 ideas? Well, in fact, we've done that because there's a way of customizing these ideas per user. So you can actually come into what are called the custom settings, and you can tell us something about what it is you're looking for. As an example, what are the exchanges from which you would like to get your ideas from? So I've selected here Euronext Brussels, Euronext Paris, the London Stock Exchange, and the NYSE Euronext. I could add other exchanges if I want, so perhaps I want to add the NASDAQ. So I've got that added as part of my ideas now as well. Asset categories, I said I'm looking for stocks. I said I want bullish ideas and bearish ideas, but if I'm just looking for bullish ideas, I'm very bullish on the market right now, I could say I want bullish ideas only. And what is my holding time frame? How long am I going to hold these investments for? Is it a short-term trade, something I'm in and out of at 2 to 6 weeks, something I'll hold a little longer, maybe up to 9 months, or something I hold perhaps up to 2 years? So maybe I'll say I want to hold maybe up to 9 months. Then we have research preferences. How do I want these ideas chosen for me? Stocks with great fundamentals, or am I more interested in the charts, or both? And then what sectors of the market do I care about? Maybe I can take energy out if I don't like the energy sector. I can say done. What happens is we'll now re-customize these ideas based on what you've told us, and every day we'll remember your custom settings and try to present to you ideas that are tailored to your interests. So notice now all these ideas are green because I said I only want bullish ideas. So please try the featured ideas out. I'm sure it's going to give you some interesting things to think about. The other thing I'll mention while we're on this page in terms of getting some trade ideas is there are some interesting stock screeners available. So there's a fundamental screener, there's a basic technical analysis screener, and we have what's called the advanced technical analysis screener. I'll just quickly show you the advanced one. Let's suppose I was looking for a very particular kind of trade idea. I want a trade idea from a particular part of the market. So maybe I think that the financial services sector is a little bit oversold right now. I could say that I want to focus on financial services stocks, and I could pick the exchange or country. So maybe I'm going to say in the UK, the London Stock Exchange, and I care about, let's just see here, let's try and find banks. There we go. And maybe I want to have a certain market cap, so I only want big banks, so maybe $1 billion market cap. And then I want to look, let's suppose, over the last 2 weeks for bullish classic patterns or short-term patterns in that market. So I'll say search. So we'll look into Recognia's database and see if we can find any examples of technical events that match the requirement that you've actually put in place. So actually here are a bunch of stocks that trade on the London Stock Exchange that have had bullish technical events over the last 2 weeks. Okay, so Virgin Money Holdings I see, Barclays I see, Bank of Ireland I see, and so on. And incidentally, you can view these in different ways. Many technical traders are kind of very focused on the charts, so you can have what's called the chart view, just look at a bunch of charts. Or this is called the detailed view, where you can see the chart plus what's called the event block for everyone. Or the standard view is that kind of more text-based one that I showed you like this. So another way of getting some trade ideas every day is by using the advanced technical analysis screener. Now, of course, you may say, well, I already have an idea. I've already got a stock that I have in mind. Just tell me, is today the right day to buy? So let's take a look at a couple of examples like that. So, I've looked up a couple stocks. Here's one that I was looking at earlier called Solvac, which trades on the Euronext Brussels. And here I've got a quote for Solvac. If I go to the full details right here, this is going to bring up for me a larger research center for this particular chart. And I'll highlight for you first and foremost, as I scroll down here, there's this technical analysis widget here that summarizes for us what is the technical outlook for this particular stock, Solvac, based on technical analysis. So we're actually saying that in the short term, Recognia sees this stock as being neutral. We see it as being bullish in the medium term, and we see it as being bearish in the long term. And by the way, short term is periods from 2 to 6 weeks. Medium term is periods from 6 weeks to 9 months, and long term is more than 9 months. Do you remember Charles Dow and his market cycles? That's where those time frames come from. Short-term trend, and intermediate-term trend, and the long-term trend, those are what determine these price cycles for us. Now, if you want to find out more information, what we can do is, let's go back to the top, and there's all this navigation here. I'm going to go to the technical analysis chart, or technical analysis section. What this will do is show me all the different technical events that are currently active for this particular stock. This is a 2-year price history for the security. Notice all these little red squares along the way. Those red squares represent the dates where we have had bearish technical events. The green dots, on the other hand, are the dates where we've had bullish events. So notice that we had a bunch of red dots kind of historically, but more recently it's been a lot of green dots. So we actually right now have 8 bullish events and 9 bearish events active. And if I scroll down, here are all those different events. So notice that between February 12th and March the 18th, it was all bullish, all green bullish events. The price actually moved from $79 up to $893, or euros, sorry. And then on the 18th of March, we had a whole series of bearish events start to occur. Short-term bearish, long-term bearish, and so on. And the prices actually started to fall already. So let's just go down and look at this particular event here. Here we had a bottom triangle occurring on February the 12th. Let's just do a little bit more investigation into that bottom triangle. So here is that particular bottom triangle here outlined in red. So notice we were in a steep decline coming into this bottom triangle. The triangle has those converging levels of support and resistance. We broke out above the upper level of resistance, indicating the start of a new bullish trend. And look what happened. The price immediately ran higher from 80 euros up to 95 in just a few weeks. And incidentally, I can draw the target price region on this chart just by clicking target price here, saying update chart. That'll update with that green rectangle drawn on it. And if I want this drawn on all my charts going forward, there's a place where I can save my settings somewhere, which I'm not seeing. But I can actually save those settings, and I can have it saved for me within the chart going forward. We also talked a little bit about support and resistance. Notice if I come here, there's a whole section on support and resistance. So I can actually find out automatically where support and resistance levels are found. So we were saying Recognia found support at 79.85, so right at just below 80 euros. And we found resistance at 94, which is right about where we are. So we're actually right at a resistance level now. So that can be very, very useful to you as a trader. Let's try one more example here maybe. Let's try an American stock. Let's try Cisco. Cisco Systems trading on the NASDAQ. And what does Technical Insight think of Cisco? Well, here's a stock that's is in an uptrend for a good part of 2014, but it's done really nothing for the last year. Had a huge decline in early 2016, declined from $28 to about $22, but as of late, it's gained a lot of that back. And if we can see by all these green dots, look how many bullish events have occurred recently. So scrolling down, we have lots and lots of green here, lots and lots of bullish events. Incidentally, I can view this in different time horizons. This is called the summary view, but I can equally well look at just the short-term events. And in the short term, I have 5 bullish and 3 bearish events. In the intermediate term, I have 5 bullish and 2 bearish. And in the long term, I have 3 bullish and 1 bearish event. So here's an example of a stock that's looking bullish in all 3 time horizons. We have all 3 trends moving in the same direction: short-term trend, intermediate-term trend, and long-term trend. And if I just go back to the summary page, we look at our little widget here, technical analysis widget. Where is it? Sure enough, it's showing bullish in the short term, intermediate term, and long term. So that's a little bit of a summary of how you might use technical insight as part of your investing and trading workflow on the Bolero site. So we've used about 45 minutes of our time. So what I'm going to do at this point, I think, is turn the webinar back to Jan, and we can see if there's any questions from the audience. Over to you, Jan.
Welkom terug iedereen. Bedankt om te blijven kijken. Peter, thank you very much for that very clear presentation. Nog een aantal kleine noten. Dus zoals jullie kunnen zien zijn de mogelijkheden via dus die zoekmotor, laten we maar zeggen, van Recognia in de website, die zijn enorm. Je kunt daar zo ver in gaan als dat u zelf wenst. Weet, op de website staat er ook heel veel informatie over verschillende indicatoren, technische analyse dan ook. Dus zijn er zaken die u niet kent of begrijpt in die tool van Recognia, ofwel gaat u daar een kijkje nemen of stuur ons een mailtje. Ook online is daar heel veel informatie over te vinden, over hoe die zaken allemaal werken. Nu, zoals met veel zaken, ook hier bij technische analyse, betekent ook, of niet noodzakelijk, hoe complexer, hoe beter. Dus maak het allemaal niet te complex, ook niet. Dat is zeker niet nodig. Maar gebruik gewoon die indicatoren en trends die voor u een meerwaarde betekenen. Ook bij technische analyse maak u eigenlijk ook geen blazenwijs. Dat is iets dat we vaker zien bij beginnende mensen in technische analyse. Als u het patroon niet ziet, dan is het er niet. Ga er niet naar op zoek. Volg dan gewoon een ander aandeel waar u eventueel wel duidelijke patronen ziet. Pieter gaf hier juist ook aan, trendlijnen kunnen getekend worden vanaf 2 raakpunten. De meeste gebruiken er zelf 3 of nog meer. Soms dus daar ook, ga daar genoeg conservatief en dus consequent mee aan de slag. Als laatste, vooraleer dat ik afsluit, er zijn geen vragen meer zie ik, vul zeker ook onze enquête in. Moest het voor jullie echt een probleem zijn van dat Engels, laat ons dat gerust weten. Dat is geen enkel probleem. Desnoods herhalen we dit nog eens, maar dan in het Nederlands. Geen enkel probleem. Zo, dan ga ik afsluiten. Peter, I'm gonna thank you very much for the presentation. Ik zie jullie heel snel allicht voor het volgende webinar. En dan wens ik jullie nog een zeer prettige avond en veel succes op de beurs natuurlijk. Dag.
Bolero.be. Beleg online met inzicht.